coming now from a little different perspective, possibly starting with a little bit of theoretical thinking about why the institutions are looking back at resi. That's more or less, they realize that only investing in commercial, it's a different risk profile. You have a high granularity of the tenant base in the resi portfolios. So the risk of losing rent, it's much lower. Even if one tenant's not paying, the overall cash flow is more or less stable. And funnily enough, historically, most institutions, I only mentioned the specifically Switzerland and Germany, they had large proportions of residential in their portfolios anyway. So it's more or less a turning back to what we have seen, let's say, 40, 50 years ago of a lot of institutions. So it's nothing unusual. It was just not very modern or very up to date to be in the resi sector for about 10 years ago. When you look at the resi sector overall, a lot of talk is about demographics. And we just plotted here the house price growth on the x-axis. On the y-axis you have in red the growth of the old age dependency ratio, and in yellow you have the population growth. And when you do the little bit of a regression and analysis, what the researchers like to do, you figure out that actually the age structure is much better in explaining house price growth across Europe than the pure demographic, meaning population development. So what does it mean for the investors? For the investor, this means, first of all, as we are getting older in Europe, across Europe, that's more or less the fact. First of all, house price growth will be much more limited, because the higher the old age dependency ratio is, the less house price growth you had in the past, and that will be also continue in the future, because simply a 70-year-old household is not buying a new house anymore most of the time. So there's some pressure from the demand side if you just look for single-family houses or for owner-occupied apartments. That also will support the rental sector. Additionally, with the fact that mortgage availability, as Janet already pointed out, it's much harder to get a mortgage today than it was 10 years ago. And that is the story about the markets today. When we talk about the European residential markets, that's a little bit of a tenure split, giving you the impression what we see across Europe. You have, in gray, you have the private rented sector. In yellow, you have social housing, social rental, which not always is the typical social housing. If you look at the Dutch market, for instance, that's something that's very typically in the Dutch market, and also institutions are investing in there. In red, you have the owner-occupiers, and in green, you have some things that are classified other. And to be honest, I cannot tell you in detail what this kind of living accommodation is, but that's what you have to keep in mind. And if you want to invest in the residential sector and say, I want to build up a larger portfolio, you have to keep in mind that's what the stock is looking today. And then if you go for one slide on, and what you see is there, the gray bars are the housing stock, and the dots represent building activity. The triangles are the building activity between 2010 and 2012 in percentage of stock, and the yellow quadrangles are the building activity we expect in 2013 to 2015. And it's somewhere around 1% of the housing stock. So if you want to invest in residential, and you have to keep in mind the current structure of the housing market, because most of what you see in 10 years is already built. With the building activity of maximum 1% in most markets, you don't see a fundamental shift in the market structure in the next 5 to 10 years. Everything what we have in 10 years, it's mainly there. More than 90% of the stock in 10 years' time is already built. So if you want to invest in there, you have to keep in mind what do we have there. And if you want to create something new, for instance, like in the UK, that's why you have to build it, because simply it's not existing if it's not already there. And that is something we see in a lot of European countries. We also saw it in Spain. The Spanish government had some initiatives about 2-3 years ago when they did a roadshow across Europe trying to promote the idea of a rental sector. We have seen developments in Denmark in the last years where the people started to look more on the rental sector, as a lot of distressed developers rented out their properties and brought them to the market as a rental investment. You've seen this in Dublin in the last year with a lot of the US and especially Kennedy Wilson entering the market on a large scale, building up a huge portfolio and something. If you looked at Ireland, let's say 5-6 years ago, nobody would have thought about rental investments in Dublin. Looking now, why is this still attractive? And what I've done here is you see a little bit of up here, the yield level we think that's achievable on multifamily houses in, let's say, decent locations. It might not be the top prime end of the market, but it's a decent location. In the yellow triangle is the government bond yield of the respective country, and the gray bars on the bottom are the yield differential between the lower end of the yield band and the government bond yield. And that is more or less why investors are still attracted to residential. It has an attractive yield profile given the risk associated with it. The risk is not much higher than a government bond. Yes, the liquidity is lower, but at least you have a premium. The only thing is, in some markets, it's quite hard to find the stock. So that is a little bit of the expectation. If you look forward, 2014 onwards, you will have decent returns in most markets that are more or less a little lower than historically, mainly due to the fact that capital growth might play a little lower role in many European markets as it had in the past. But having said this, I think the investors are adapting. They are adapting to this yellow form I've put in the middle, saying they try to do more value add other than the resi sector. It's not the typical buy and hold. They want to buy land, develop something, buy something to split it up, sell it to end users. So they try to bring a more diverse structure to residential investments, what they have done in the office and in the commercial sectors maybe for years. So I think we will see not only changes with possibly institutional resi sector re-emerging in the UK, we also see the institutional resi sector, let's say, change in a lot of European countries, mainly the Netherlands, for instance, where you see a lot of government activities currently, but you also had government activities in Sweden trying to support the rental side. You see a lot of things going on in some of the PIGS countries, namely Spain and possibly a little bit of Portugal. So I think it will be a quite interesting time if you go forward of 3-4 years, what we see, how the investors will move to this value-add segment to really take advantage of what we see in the markets coming on. So, and that's a little bit of a quote I like very much from a Finnish architect at the end. When we talk about housing, it's much more about really that we should not concentrate on the separated problem, what a lot of countries are currently doing, but we have to look at what housing is involved in the daily work and the other functions of the city. And I think that's increasingly what the investors, or at least what governments are realizing. Investors are maybe not still on that point, but if you invest in resi in the long run, you have to look how this investment fits into the city structure and the city functioning, because then it will be a successful thing. If you just look at the single investment without looking at the network and the connections to the city overall and the city functioning, it might not be that profitable on the long run, especially if you want to exit the market. So that is a starting point. If you're interested in one of the reports, we put out some. Otherwise, give me your card. I will send it to you. Thank you very much.
Great. Thank you, Mark.